Most people enter the market with one goal: make money. But here is the problem nobody warns you about. There are two completely different ways to do that, and if you pick the wrong one for the wrong reasons, you will lose money not because you were unlucky, but because you were playing the wrong game entirely. One is called trading. One is called investing. They sound like the same thing. They are not even close. And by the end of this video, you are going to understand exactly how each one works, what the real downside looks like when things go wrong, and which one actually makes sense for where you are right now. You have probably seen the charts, the red candles, the green candles, the guy on social media flipping $500 into $4,000 in a week. And some part of you thinks, why am I not doing that? That is the exact question I want to answer today. Because the reason most people do not do it is not laziness, and it is not lack of access. It is that nobody ever explained what they were actually signing up for. So let us start with trading. Trading is buying a stock at a low price and selling it at a higher price in a short period of time. We are talking hours, days, sometimes weeks, not years. The entire goal is to catch a price movement and exit before the direction flips on you. To do that effectively, traders use something called technical analysis. Technical analysis is the study of price charts to predict where a stock is heading next. You have seen those charts with the red and green bars. That is called a candlestick chart. Each candle tells you what happened to the price during a specific time period. A green candle means buyers outnumbered sellers. Price went up. A red candle means sellers outnumbered buyers. Price went down. Traders study the patterns those candles form and use them to make predictions about what comes next. Here is a simple example of how that plays out. You spot a stock sitting at $10. Your analysis tells you it is about to bounce. You buy one share. It climbs to $13. You sell. You just made $3. Then it pulls back to $11. You see another signal. You buy again. It pushes up to $16. You sell. That is another $5. Clean, fast, repeatable. That is the dream version. Now, here is what actually happens the majority of the time. You buy at $10 expecting it to rise. Instead, it keeps dropping. This is where something called a stop loss becomes your only real protection. A stop loss is a rule you set before you ever enter a trade. You decide the maximum dollar amount you are willing to lose on this position. If you set your stop loss at $8, your position sells automatically at $8 before the damage gets worse. But here is the part that does not make it into the highlight reels. You stop out at $8. You lost $2. The stock dips a little more, then ticks back up to $9. You read that as a recovery signal. You buy back in. It drops again, hard. You stop out a second time. Now you are down $5 total, and you followed every rule in the playbook. And it goes the other direction too. You buy at $10. It climbs to $13. You sell, lock in your profit, feel good about your decision. Then you watch it keep running all the way to $17. You made $3. You left $7 sitting on the table. Correct execution, incomplete outcome. That is the daily reality of trading. The analysis is never perfectly accurate. It requires constant attention, fast decisions under pressure, and the emotional discipline to take a loss without immediately trying to win it back. There are three main forms trading takes. Day trading is the most intense version. Everything opens and closes within the same trading day. Swing trading means holding for several days or weeks, targeting medium-sized moves in price. Position trading is the longer end of the spectrum, holding for months to capture a bigger trend. And trading is not limited to stocks. Forex trading is buying and selling currencies, betting on whether one currency strengthens or weakens against another. Commodity trading covers physical goods like gold, oil, and agricultural products. Crypto trading covers Bitcoin, Ethereum, and the rest of that market. Now, let us talk about investing, because it operates on a completely different clock. Investing is not about catching price movement. It is about betting on a company's future. You buy, you hold, you wait, sometimes for years, sometimes for decades. The short-term swings in price are almost entirely irrelevant to you. Investors do not rely on technical analysis. They use something called fundamental analysis. Fundamental analysis means you are evaluating the actual business, not the chart. Is revenue growing year over year? Are profit margins expanding or shrinking? Is the company building a real competitive advantage in its market? Investors look at metrics like earnings per share, return on equity, and cash flow to answer one core question. Is this business actually getting stronger over time? Let me walk you through what that looks like in practice. Say you find a company called WeeWee Shoes. You do your research. Revenue is growing. New store locations are opening. Online sales are doubling year over year. You believe in where this business is heading, so you buy 10 shares at $50 each. That is $500 invested. The company keeps executing. New designs go viral. Revenue climbs further. On top of the stock appreciation, WeeWee Shoes pays a dividend of $2 per share every year. With your 10 shares, that is $20 landing in your account annually just for holding the position. 5 years later, the stock is trading at $150 per share. Your original $500 is now worth $1,500. Add 5 years of dividends, and that is another $100 on top. Total gain, $1,100 on a $500 investment. You did not watch the chart every morning. You had conviction in the business, and you let time do the work. But here is the honest version of this. Investing takes real time, and most people do not want to wait. Warren Buffett started investing at 11 years old. He became a millionaire at 32, a billionaire at 56. That is 45 years of compounding before he reached the number most people picture when they hear his name. As Buffett himself put it, nobody wants to get rich slowly. That is not a knock on people. That is just the honest reason most people avoid long-term investing, even when the math clearly favors it. Investing goes well beyond stocks. Bonds are essentially loans you give to companies or governments in exchange for regular interest payments over time. Mutual funds pool money from thousands of investors, and a professional manager decides where to allocate it. They take a fee for that service. ETFs work similarly to mutual funds, but they trade on the stock exchange the same way individual stocks do, which typically means more flexibility and lower fees. Real estate generates rental income and tends to appreciate in value over long holding periods. Cryptocurrency sits in this category too, though it behaves more like a speculative asset than a traditional investment for most people putting money into it today. So let me make the real difference between these two as clear as possible. Trading is short. Investing is long. Trading is hours, days, weeks. Investing is years and decades. Trading is built on technical analysis, price patterns, volume signals, momentum. Whether the company is profitable or losing money is completely irrelevant to a trader. If the chart says buy, you buy. Investing is built on fundamental analysis, revenue growth, profit margins, business model strength. Whether the stock dropped 8% this week is completely irrelevant to a long-term investor. If the business is still executing, you hold. Trading is harder, more stressful, higher risk. If your read on the market is right, you can make serious money fast. If your read is wrong, you can lose serious money just as fast. Investing is slower, more patient, less volatile in the day-to-day. Here is a real number to anchor that. If you bought 100 shares of Apple in 2008 at roughly $3 per share, that is $300 out of pocket. You held it without touching it and checked back in 2024 when the price was around $220 per share. Your $300 became approximately $22,000. You did not time anything. You did not watch a single chart. You just held. Now the question everyone eventually gets to: which one is actually better? The honest answer is, it depends on three things: your financial goals, your risk tolerance, and how much time you can realistically dedicate to this. If you want faster returns and you are willing to absorb real losses on the way to developing a real skill, trading could be the right path for you. But go in with clear eyes. It functions like a full-time job for the people who actually do it well. Constant market monitoring, constant decision-making, the emotional weight of being wrong and watching real money disappear. Most traders lose money in their first year. The ones who survive treat it as a craft to develop over time, not a shortcut to fast wealth. If you have a full schedule and you want your money growing without requiring your daily attention, investing is the more realistic path for most people. The returns come slower, but the math over time is genuinely hard to argue with, and it does not require you to be glued to a screen all day to make it work. Both can work. Neither works if you skip the foundation. Because walking into either one without understanding what you are doing does not make you a trader or an investor. It makes you a gambler. And the market does not care about the distinction. If this gave you a clearer picture of how both sides actually work, subscribe. I cover this kind of content every single week. No filler, no recycled advice, just the information that actually changes how you think about money.